Today we're going to talk about Twist Biosciences, in particular the report by Scorpion Capital that was issued not too long ago. And in this picture, you can see a stinger from a giant forest scorpion. These things will grow up to be 9 inches. But the good news is that if it bites you, you won't die. So similar to Scorpion Capital's short report, it's going to create a lot of fuss, but it's not likely to kill Twist Biosciences. Now, when we look at the track record of Scorpion, we see that they've put out some short reports that cover stocks here and analyze. QuantumScape and IonQ are two that we're avoiding so we can understand their points of contention there. And the other two here, Ginkgo and Berkeley, we're going to talk a little bit about those. So in particular, Berkeley Lights, that was the first time that we came across a Scorpion Capital short report on a stock that we were holding. And you can see here that we ended up deciding to sell the stock on the back of that report, but also because it coincided with some of our own suspicions and concerns about BLI. Now, when you look at the outcome, since we exited that stock, it's fallen 89%, but price action isn't indicative of a successful outcome. It's only when the company sees an exit that we'll know for sure. But what happened since that short report is quite telling. So they missed the revenue guidance for 2021 as Scorpion had predicted, and as we suspected, they were overselling their capabilities. The company CEO was then demoted in early 2022 with no successor. That usually tells you that it's forced exit. And then they said most recently that they're expecting full year 2022 revenue to be in line with 2021 revenue. So where's the growth? And that pretty much solidifies that. When we exit a position, we do so with conviction and we don't look back. So then that brings us to Ginkgo Bioworks. They got stung by a Scorpion report, and we've written extensively about this firm. And the initial response was rather flippant. And then the Department of Justice issued an inquiry, and it was determined that no fraud was taking place at Ginkgo, and not much else was said from their side. Now, our points of contention about this firm, we're interested in their foundry that harnesses the power of nature to do amazing things. We're not interested in COVID anonymous population testing, and we think their related party revenues are rubbish. So we focus on what we call pure foundry revenues. The other point of contention we raised not too long ago is that there are two C-level positions raking in $728 million a year, if that makes sense to be compensating two individuals that much. But the latest, we just took a quick look, their Q3 2022 pure foundry revenues are $14.7 million. That's 59% of total, versus last year they had pure foundry of $21.6 million, 62%. So they're moving in the wrong direction. Now, we'll likely revisit Ginkgo once they've completed 2022 to see where they're at. Now, that brings us to the company we want to talk about today, Twist Biosciences. You can see here the captions on this short report are pretty grave. So it says it's a Ponzi-like scheme that will end in bankruptcy, so phony it may be criminal. And the report is broken down into 7 sections that we've paraphrased here and grouped. So they are as follows. They believe Twist Bioscience is subsidizing customers by offering DNA synthesis services at less than cost. That would imply the cost of goods sold is wrong. The flagship DNA chip that they have doesn't work as advertised. And of course, they're incorrectly stating cost of goods sold by allocating some of those expenditures to R&D and capital expenditures. They claim Twist is a bottom-tier vendor with poor reputation that caters to small, price-sensitive academic labs and biotech startups. They're operating in a commodity-crowded, hyper-competitive space. Growth has peaked. Their TAM is minuscule because they can't compete against large players, and there are 20 new companies entering. And then lastly, this bit about how some of their investors from China are shady. We largely just glossed over that and grouped these bits into 2 categories. One would conclude that Twist cannot operate a profitable business. The other would conclude that revenue growth is coming to an end. Now, in a recent piece we wrote about Twist earlier this year, we were concerned about some of the same things. We say here from this article that I'll link to in the description of this video, we say Twist is competing against some very established companies and spending a ton of money to do so, particularly on the sales side. And then we had concerns around their business model taking a services approach as opposed to a hardware product consumables approach that a company like DNA Script is taking. So when we look at the increased capital expenditures for Twist, here you can see they've sharply increased. And on the right here, a lot of that money is going into what they're calling the Factory of the Future. It's something they're building out in Portland. Why they chose the City of Roses, I'll never know. That place is probably one of the worst cities on the West Coast. It's an absolute mess. But they've decided to expand there. And you can see here the capital expenditures, where they're going, mainly to that facility in Portland that, by the way, Scorpion had a private investigator visit who said that he didn't see much activity there. That can easily be explained away by something we'll show you in just a second. But when it comes to R&D, here you can see how much money they're spending. Note that stock compensation there is a non-cash expense. So that can, however, lead to dilution. Here you can see they're spending a sizable amount of money in R&D on DNA storage, antibody, SynBio, NGS, their core offering, probably relating to the enzymatic approach that they're building. And then you see this bit here on Revelar. And the latest earnings call, they had funded this spin-out called Revelar, and they said, we didn't see the outcome we're hoping for. We invested a small amount of capital in a long shot, et cetera, et cetera. This illustrates our discipline when it comes to investment decisions. So that flopped. But be that as it may, when it comes to dilution, you can see here that shares outstanding are increasing slowly over time. That's certainly something to pay attention to because it flies under the radar of most investors. Now, when we look at their roadmaps between 2021 and 2022, you can see here where they talk about begin initial production in the Factory of the Future. That was supposed to happen this year. However, this year they say, well, that's going to happen in early next year. And what they said in their latest earnings call is that there's somewhere around 170 employees there now, and that later this month they're going to be opening it up for people to visit. So if you're in the Portland area, get yourself down there and check it out. Now, what's next for their core bits, what they call SynBio and next generation sequencing? I took this from an investor deck they published in August, and I wanted to focus on the last sentence there where it says, adjusted EBITDA break even at $300 million for core business. This is the core business. So that's what we want to pay attention to, because if the accusation from Scorpion Capital is correct, they can never operate a profitable business. They have no business, in other words. So that's something we need to pay very close attention to. Now, when you look at the financial commentary from the latest earnings deck, surprising that they give guidance for next year and the following year. Companies typically are less inclined to give guidance because of the macroeconomic headwinds and all the uncertainty in the marketplace. For them to actually give 2 years guidance, that tells you that this was probably in response to that short report. And you can see here where they've just doubled down on operating expenses. So $365 million for the coming year, and then even more, $386 million for 2024. But look at the revenue growth there. So strong revenue growth. But what we really want to pay attention to here is runway, and that's the last sentence in each of these columns, and it says that their projected year-end cash balance for fiscal 2023 is going to be $300 million. Then for fiscal year 2024, $170. So that means they're going to burn in 2024 $130 million. That means they should be burning less than that in 2025, so they should have runway all the way through 2025. Now look at the bottom here. They talk about driving towards profitability for core business, but they've lost that reference to $300 million. So we'll certainly hold them to that. They talk about here about their segment biopharma, how they have line of sight to adjusted EBITDA break even at $80 million. So I think they're estimating $40 million for 2023. So let's say maybe $60 for 2024. So we would expect them to have achieved profitability when they get through 2025, just based on the language and everything that we've read thus far. Now, when it comes to the total addressable market, they put a lot of emphasis on this DNA data storage, which sounds quite sexy, but when you look at the application, so for example, tapes, magnetic tapes as a storage medium, that's somewhere around a $2.75 to $5 billion total addressable market based on the research we've done. Not very big. They peg long-term archival storage at around $35 billion. So what we're going to do there is have a look and see just how DNA data storage is coming along. We've written about that extensively over the past years, so we're going to do a deep dive into that just to try to understand feasibility and whether or not their target of having a pilot accessible by customers at the end of next year is reasonable. And then I wanted to briefly touch on DNA Script, a firm that's developed a benchtop instrument. They've taken in close to $500 million. And in our last piece, we were talking about how if they ever had an exit, an IPO, we'd certainly be taking a look at that very closely, because they're building a razor and blade model that's very attractive compared to the services model that Twist has. And they're using this enzymatic approach. And not long after we had published that piece, we did an update in the same month to say that Twist unveiled their own novel approach to synthesizing DNA enzymatically, which they had spent the last 18 months developing. They also announced they'll be enabling next-generation sequencing workflows for PacBio and singular genomics. And when we looked at their latest earnings call, these sentences are taken from a transcript by, I believe it was Seeking Alpha, and the lady who runs Twist has a very strong French accent, so the transcribers are having a difficult time, the AI algorithms. But they say here, we're not giving an update at this point on enzymatic synthesis, but they're re-emphasizing that it's going to be a key strategy of our better storage product offering. And look at this last bullet point. The only way to get low COGS and high margin is to tether that NTP to the enzyme. So what they're saying is that to get the sort of 60 to 65% margins they're looking for on the DNA data storage side, they need this enzymatic approach to work. And perhaps that's where the R&D dollars are going. If it doesn't, one wonders if they're going to be able to realize the sort of margins that they're promising investors. Just some additional comments. Relating to that bullet point on Chinese investors, there was one bit there that was somewhat concerning. An investor had said, we'll invest, let's say, $50 million in your firm, but you need to promise that you'll invest, let's say, $15 million in a, or I think it was 25, in a China subsidiary, kind of round tripping. Didn't really like that. We don't care about orders. So for whatever reason, Twist emphasizes a lot about orders. So everywhere in their investor decks, you'll see mention of orders right alongside revenues. We don't care. We just care in revenues. So they had actually made a change to commissions, which means that they'll be based on revenues instead of orders. Good, because revenues are what matters. And then in response to the short report, they had issued a press release and talked about their focus on ESG, irrelevant to the items that Scorpion brought up. In fact, we'd argue that they're wasting a lot of money on frivolous things like ESG. It's a black box that no ESG, let's say, organization is able to describe exactly how they calculate their numbers, and they're all different. ESG is largely busy work. It's not needed. And we noted on their blog there that they now want to start telling us what language we should use. So Twist Bioscience says we shouldn't use the word powwow for whatever reason. Maybe they should have a powwow and focus on getting this company to profitability. So just to conclude, Scorpion's report reiterates concerns we had about the firm getting costs under control. Competing with the likes of DNA Script, can they do that? Their latest earnings call doubles down on their plan and does seem to react to the short report accusations, though in their earnings call they specifically say we're not going to comment on the short report. But the analysts were asking some good questions surrounding that. By the way, ARK Invest is an investor in Twist Biosciences. If you would have seen their alert, they just largely dismissed it. It's never wise for an investor to dismiss a short report because based on our own experiences, there's always some truth or some insights in there that are useful. So any signs of revenue growth slowing down will affirm Scorpion's accusations. And we want to see from Twist an increased focus on profitability through reducing their cash burn over time. And we need to pay attention to dilution. So on our side, we're going to hold a powwow on what to do with our half a position size that we're currently holding of Twist Biosciences. So let us know your thoughts on Twist, whether or not you're going to be selling or buying as a result of the short report. Please make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.